So the reason this reverse can't go on forever is because it's based on the individual and their age, just like life insurance. It's the exact same thing. So when they die, you can't just carry it over. It's like they've based all the numbers based on the life expectancy of the borrowers on the loan.
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of Ducharme Wealth Management, where we try to give education to our listeners so that they can have better, more impactful, and more meaningful and effective engagements with the financial professionals around them that they will potentially need to engage with, or their parents will need to engage with. So today we have Chantry Abbott back on the podcast. He is a mortgage loan officer at Guild Mortgage. In fact, this last year he won the Branch of the Year award for Guild Mortgage. There's like over 500 branches in the U.S. It's a nationwide bank. I think Chantry's a high caliber individual that has a lot of insight to share about reverse mortgages today. So without a further ado, let's hop back into the show. We're here to talk about reverse mortgages today. They're now called home equity conversion mortgages. No, a reverse mortgage is a dirty word for most people. I think every time I say it, I can see it on people's face. They're like, what?
Yeah.
A what? You think I should consider like, what, do you hate my kids? You know? And really at the end of the day, they used to kind of be that way, right? Like I grew up thinking reverse mortgage was a dirty word. And I would say until a couple of years ago, I thought it was a pretty dirty word. Until I, learned some more stuff by some great LOs like yourself that helped me understand and gave me some more education. I will say some LOs still pitch them really hard, and I don't think they're still not for everyone.
For sure.
But correct me if I'm wrong, Chantry, it was like 2017 or 2018 when the FHA kind of took over or launched a program for reverse mortgages. They call it the home equity conversion mortgage. Mm-hmm. And so now it is a conforming loan that is regulated, I guess you could say, right? Regulated by...
Yeah, it's probably more regulated than anything in any FHA, other program.
Yeah. So similar to like, hey, if you get an FHA loan, or, sometimes people call them like a first time home buyer loan or a VA loan, right? There's these parameters, right? It's a government backed loan. There's implications of that for the lender, right? There's more security because it's government backed, but because of that, also it has to meet certain requirements. They have to operate a certain way. There has to be certain costs or lack thereof, and parameters. And so now it's I'm going to call it a more viable program, right? I think there's more use case for it because of what I've been explained to as kind of the safety features they put in place for people.
Yeah. The problem with the reverse mortgage and where it got its bad name is they were all proprietary reverse mortgages. So a Wells Fargo had their own reverse mortgage program, and a Chase and a Citi and all these large banks had their own reverse mortgage program, and they all had different rules.
Okay.
Different protection pieces or not. Some, if you got upside down in equity, you would have to probably fix that and lose the house. That doesn't look very good on the front page of a paper that you're kicking an old lady out of her house. How could you have a program that allows that to happen?
Right.
And they all just had different rules that made it very confusing to the customer. And if it's confusing, it's already confusing enough if they're all the same rules. It's still hard to explain it to somebody sometimes.
Yeah.
And so if they were all different and they were getting all these different messages, they might get into a bad product, or they might have a loan officer that doesn't even know what product he's putting him in and just like, oh yeah, this is what my company told me to sell. And so here you go. And it'll just put people in bad spots.
Yeah.
Or their kids. So FHA took it over. Every reverse mortgage goes through an FHA. There's like one unique proprietary program, but you clearly know that's what you're doing. I have never even done one. But all of the other ones, regardless of if you come to me or local bank, local credit union, if it's a reverse mortgage, a HECM, home equity conversion mortgage, we've all got the same rules.
Yep.
Same fees you can charge. The most important thing is the protection points that the people, the borrowers have, and that their estate ends up having. Because that's what you can't have, is you can't have this big loss or something like that kicks them out of the house or makes them homeless.
Yeah.
So yeah, it's made it really nice. It's actually made it really nice too, because one of the things they make them do is the last thing in the world I want to do is have somebody get a reverse mortgage and then 2 years later they're upset with me because they think I shoved them into the wrong thing to get my commission. One of the things they have to do with this is they have to go take a separate independent reverse mortgage counseling. It's like a little class they have to take. And basically, it isn't like a passer, it's not like you're going to fail a test or anything.
Yeah.
But it's, do you understand what you're doing? Here's how it works. They kind of took the reins away from the loan officer to explain it incorrectly or sell them on the wrong thing. Because those guys are independent and they're just kind of going through a series of, here's how it works, here's how it works. And then do you understand that? Does that make sense to you? Are you good to go?
Yeah.
And I actually have had one time, many years ago, an older lady, and it did start, it was one of those things where it started out great and it started to feel funnier as we got down the process of it. She was like in her mid 80s.
Yeah.
And she has a son that was in his early 60s. And he came to me as if he was doing this huge financial benefit to her. But he was super involved in the whole process. Mm-hmm. And when they did the counseling, he was actually on the phone, which they really don't like. If you're not a borrower on the loan, they really don't want you on the counseling. They'd really prefer you weren't, because they don't want you manipulating the situation or answering questions. They want it to be just between the borrower and them.
Yeah.
They will let you jump on. But anyway, she's on the phone and he's jumping in and answering all these questions for her. Mm-hmm. Almost like trying to hide something.
Yeah.
And so I got the counseling certificate back and the counselor says, I'm willing to give this a second opinion, but I don't think she's financially capable of making this decision. And I don't think this is what she wants to do. I think this is the son manipulating the situation for his personal benefit. Yeah. I can't remember what the benefit was, pulling some equity out or something. And so then we just canned the loan and said, hey, sorry, man. And he was not happy.
I bet.
But what I like about that is that was a bummer for me not to close one deal. But what I like about that is that I can tell that story and say, look, this has got to be for you. I can't shove you into this even if I wanted to.
Yeah.
I can't leave anything out. I can't tell you only the upside, because you're going to go to this counseling and they're going to know if I've misled you.
Yeah. I think behaviorally, maybe that's because you have a high level of integrity. I think I would be lying to myself if I said that I believe that everyone in the industry has the level of integrity that I think you have, Chantry. And not to say that all or a majority of loan officers are bad, right?
Most are great.
Most are
like
great.
Anything.
Just like any industry.
Most are great.
And my own industry has a great example of that. There's horrible actors that can be high pressure people. And so I think people still can be manipulated, but it sounds like there's a pretty good safeguard in place to try and negate that problem. It does give an easy out and one of the things that I think would be really easy for somebody is if they are feeling pressured by their loan officer in that counseling, it sounds like they could just kind of say like, no, I really don't feel comfortable with these ideas. And they could kind of force that counseling person to not issue the certificate,
sure,
thus killing the deal so that the kind of high pressure guy can't come back and apply more pressure. Right.
Sure.
Would that kind of be how it works?
Yeah. And one of the main things you talk about your industry is that financial pros and mortgage guys were teaming up and putting these into investments and doing all this other crazy stuff that really wasn't the right thing to do. And that's really part of why this all came down.
Horrible idea.
You're about the only one that gets that. All these other, they're like, well, you give me $200,000, I can make this amount of money. And it's like, well, you're losing the equity. There might be some right things to do with it. But I don't think they ever looked at the holistic picture.
Well, I think back during COVID when mortgage rates were so low, you could have taken a sophisticated investor, high net worth individual that is very savvy, understands what they're doing. And was there a chance for them to take on risk in their personal life by pulling home equity out, using a reverse mortgage late in life, and then investing that money and, leveraging, that's leverage, right? Leveraging that money to get a return greater than, the interest accrual on that. I think that I'm sure that could have happened
for sure.
I would say that's really, really so uncommon, really uncommon. And I tend to even think that most people in that situation still they're like, well, I don't want to leverage my primary residence.
Yeah.
All right. I still live there. It's just like people at that stage of life tend to also say, enough can be enough. You know? So you're really talking about someone hyper specific that has a massive net worth that is just interested in continuing to grow it. That's so rare.
Yeah.
So
they're in their forever home. They just built their custom forever home. They're never going to move out of it.
Yeah. Yeah. It's, so but I see a lot of people have it. One of the common things that I got pitched a lot in 2022, by people trying to, do reverse mortgages is they would come to me and say, well, Brandon, you should have your clients get reverse mortgages as a volatility buffer, so that way they can pull money off their home equity and not pull money out of the markets while the stock markets are down and this or that. Well, I mean, we did fairly well in 2022, so that really wasn't a big concern. I think our planning extends beyond, having somebody at late stage, in retirement being all equities. Now in 2022, you had the bond market fall apart too. So most people in traditional asset allocations did have an issue here, but I would always kind of say that and say, well, I just, I don't think we're really necessarily, I'm not seeing that a lot or like where that would come into effect. And I'd kind of have two follow-up questions, or my biggest follow-up question is like, well, what's the cost? Because if you're going to save, if your projection is something's going to recover, but it's going to cost you $10,000, $15,000 to take that bet, well, you got to weigh that into the kind of, the overall picture here. Right. Sure. And so now it's a question of, well, how much does it cost to set one of these up and kind of originate it? And as I'd ask more questions, I find that some of these people, they would lead me to say, or they wouldn't lead me to say, they would lead themselves into eventually saying the quiet part out loud, which was, well, Brandon, if you get them to pull money off their reverse mortgage, that means there's more money in their portfolio. So you manage more money and you make more money.
Yeah.
And it's like, that is ass backwards.
Yeah.
That is not how this works.
Yeah.
In fact, I told one person that I actually kicked him out of my office, and I just said, like, not only am I not going to send it, like, don't add me to your mailing list. Don't call me again. I'm not interested in any of these conversations. And, anyway, so maybe one of the things we should talk about is what is the cost of a reverse mortgage? Because I think that's something that people aren't always aware of until all of a sudden they are.
Sure.
What does that look like?
So the biggest expense to the reverse mortgage is the entire reason the loan's possible. Mm-hmm. It's considered a non-recourse loan. What that really means is they can never come after you or your spouse or your kids or your estate for anything owed above and beyond just the actual property. So you're never going to owe money. They can't come after you for money.
So this is like, to just put kind of numbers to this scenario, right? You start a home, a reverse mortgage, you go to, pass away, the housing market's dropped, your home's worth $400,000, but your balance on the mortgage is $500,000. Mm-hmm. Right. So now you're what would be considered upside down.
Yep.
And you're saying there's no recourse they can take.
Yeah.
And so they can't come back and say, well, the estate owes us $100,000.
Correct. And what happens is, this is where the FHA comes in, is that, and this is the expense too, is 2% of the purchase price or value of the home, I should say, on a refinance, value of the home.
Okay. 2%
of the value of the home. So say a $500,000 house, there's $10,000 in a mortgage insurance policy purchased. That is a closing cost. It's a lot of money.
Yeah.
And there's normal title fees, appraisal fees. I mean, on a $500,000 house, you're probably not too far away from it costing this individual $15,000 to close the loan. Something close to that. And that's like the starting point of your loan. And the other thing about that is that there's interest. So that's probably the one thing for everyone to understand. Here's how I try to lay out the simplest way the reverse mortgage is. You are getting a loan. You are being charged interest for that loan. You have the choice to not make that payment, and it's going to add on to your loan balance every month.
Yep.
Compounding, unfortunately. You can always choose to make the payment so that your loan balance doesn't grow. You could pay the interest every month. The reason you would do that is every dollar that you put in gives you an available line of credit that you could borrow it right back out. So the nice thing there is, and I actually don't even agree with most people that do this. I'm like, the number one benefit of the reverse mortgage, in my opinion, isn't taking money to invest. It isn't earning income. It's being able to have the house that you want without having to make a monthly payment for the rest of your life, you or your spouse.
Yep.
The investment side of it, I've never been super into it. There's certain situations that make a lot of sense. But for the most part, it's typically eliminating your biggest expense in retirement, which is your housing costs.
Yeah.
So like my grandparents did it, and they had some asset, but they were self-employed, sold their businesses. They had a little bit of cash, but they didn't have a lot of monthly income. Mm-hmm. And there was like two choices. Choice one was like, go buy a little condo that they can afford to pay cash for. Mm-hmm. That was really sad for them to think, because my grandma's favorite thing was hosting family and having family get-togethers and Christmas and things. It was like her thing, right?
Yeah.
That wasn't going to work in the 2-bed, 1-bath condo.
Yeah.
The other option was they go buy a twice expensive home that has all the room. In fact, they ended up getting a house with a pool because they thought that would attract all the grandkids to come visit, which is great.
Yeah.
And so I got together with them and the 3 kids and said, look, they're 80 years old. You guys are going to be, I mean, if they live 10 more years, you guys are going to all be almost 70. Yeah. Are you really sitting around waiting for mom and dad to die to get the equity? Or would it be better if we can get them into a situation that they can enjoy their last 10 years or so?
Yeah.
So they didn't have kids to leave. They didn't need to leave. None of their kids needed it. And so they made a lot of sense, because it was like, that was, and it ended up kind of being that at their last home. You know, they're going to be in it for as long as they possibly could. Fast forward a little bit, grandpa died. Grandma had to go into assisted living, but the family actually still made out good. They won because the market had gone up so much in the last 10, 15 years that they sold the house. And even though they had interest growing all this time, it was still a really low loan balance. You know what I mean? Yeah. So it made a ton of sense.
The equity value increase outpaced the loan balance increase.
Yeah. I've also had other situations
which isn't guaranteed, by the way. Like, and that's the last 15 years in housing, abnormal.
Yeah.
And it was great. Not a scenario I would plan around.
No,
it's a great outcome, not a great plan.
Yeah. Typically the reverse mortgage makes the most sense when, if I could change your retirement by not having a house payment. Mm-hmm. And odds are we're going to live in this house as long as we possibly can, hopefully the rest of our lives.
Yeah.
If at the end of the day there's equity and my kids get it, cool. If there's not, that's okay too. Can live with that.
Yeah.
If there's anything other than that scenario, you might want to really take a hard look and decide if it's not the right thing.
Well, I think sometimes where people get caught up is in the idea of leaving the home to the kids, mm-hmm. right? Like, and it's this idea that I want to do this legacy planning. I want to leave an estate. I want to leave something behind. And one of the things that you brought up is like, your grandparents, they die in their 90s. Their kids are already in their 70s. Like, I mean, there's always going to be someone that's life-changing too. But, you know, the odds are is your kids that are already 70 are already in retirement.
Yeah.
Or they're already ready for retirement, right? They already know how to kind of deal with this and they put their own lives together. And I think with the extended life expectancy of people, or the longer people are living, they're kind of forgetting about this, and they're forgetting to do the estate planning and the legacy planning while they're alive. And I try to talk people through this, and it's difficult because it's so unconventional. But you know, your grandparents were able to, it sounds like, leave a legacy of the holiday dinners and the family memories and all that stuff. And that stuff might be more important and more impactful to not only their kids, but their grandkids.
Sure.
Than, leaving behind a home with some equity, right? Like when, like who's it going to really benefit and to what degree and how much?
Yeah.
You don't really know, but if that's the sole reason you turned out as a decent human being, Chantry, that's, that'd be like the greatest estate planning thing they could have done. Right. Who knows? I don't know how impactful holidays at your grandparents were, but you get what I'm saying? It's overlooked that way.
Yeah. My most successful ones, the funnest ones to do, the ones that go the smoothest, the ones I feel like we're doing the right thing, is they have one kid who's kind of in charge of helping mom and dad out.
Yeah.
Kind of has taken ownership of their finances. The kid might be late 40s, early 50s, and mom and dad are 70 and tell us what to do.
Yeah.
And I meet with the 50-year-old kid.
Yeah.
And they are like, I want them to do it, and here's why. That's the best ones.
Yeah.
Because they're doing it for the right reasons.
Yeah. Yeah. I generally think like the profile of people that I see it being a really good fit for, like the people that should consider it the most are the people that come into retirement age and for whatever circumstances prior in life, they ended up where they still have a reasonable size loan balance, but not huge. So the profile that kind of put numbers, right? If you have a $400,000 home, you have a $75,000 or $100,000 left. And the only thing really keeping you from retiring now and, stopping work or cutting part-time, if that's what your retirement looks like, whatever, is just the mortgage payment.
Yeah.
That's like a great case for a reverse mortgage. Like, again, consider your estate goals, consider your legacy planning goals. But if you can eliminate that payment now and then, punch out instead of working another 8 or 10 years just to pay the mortgage off and then retire, enjoy retirement.
Right.
That's the difference between retiring at 65 and 75.
Yep.
That's where I think a reverse mortgage really can be a great tool for people to consider.
Absolutely.
I think from like a broad, easy to understand concept. Again, there's more advanced concepts, right? If you're going to use it as a more of a advanced, complex tool.
Sure.
But from using it at kind of as its intended purpose by the FHA.
Yep.
That's where I see it be.
Absolutely. Yeah, we changed their life by eliminating the house payment.
Yep.
Then it makes sense.
Yeah.
I've gone down the road of doing some though, and one was like a little. It wasn't really a cabin, but the family thought of it this way because it was like Grandpa's little farmhouse, and they loved to go visit. And the family all got together, and I was part of this with them, and I was cool with it. Is they're getting into that. Doing the reverse because the grandpa needed it. He wasn't making the money. He couldn't work the farm. He needed a change financially.
Yeah.
So he was all gung ho for it. But then the kids are like, man, what happens if he lives for another 10 or 15 or 20 years and it ends up being in a situation where the house is negative equity?
Yeah.
I said, well, you guys have to figure it out. You'll have a year. So. Yeah. They all together as kids decided we're just basically going to give mom and dad a reverse mortgage. Really what they did is they pooled in their assets and paid their current loan off and said, well, now when you die, we'll split all that out, but then we won't have to lose the home potentially.
Sure.
So non-recourse loan. Non-recourse means they can't ever come after the debt above and beyond what the home is worth. Mm-hmm. So last person living in the home passes away or it is determined that they'll never move back into the home because they're permanently in an assisted living care facility. Once it's been determined you can't live in the home, die or can't take care of yourself.
Sure.
Then you essentially get an initial 6 months. The estate gets an initial 6 months to decide what to do at the house. They can extend that as long as they're doing all the right things to get a full year. But let's say, I think you use the example of $400,000 house, owe $100,000. Maybe they've had it for a handful of years. Now they owe a couple $100,000. The kids can either pay the loan off with cash, and you'll know what you owe. I mean, that's the one thing I always, they get a statement, interest accrues, and you get a monthly statement, and you're keeping money in your bank account, but you're losing equity in your real estate. That's the trade-off. And you get 12 months to figure it out. Either pay it off with cash, come to somebody like me and we refinance it into your name, or If it's negative equity and you don't want the home, you can actually just give it back, and no harm, no foul, no dings, no money owed, no court fees. It's just simply part of the deal. You just sign it back to FHA.
Yep.
Or the fourth one is if it's negative equity, but maybe somebody in the family would like to keep the house. Then the bank will actually independently appraise it, FHA will, and they'll give you the opportunity, the kids, to buy it at 95% of that appraised value. So they're trying not to ever put anybody into a really crappy situation.
That's a heck of a deal, man. If somebody gets upside down on a mortgage, on a reverse mortgage, and the kids still get to buy it at 95% of the value. I mean, mom and dad in that case, if they're $100,000 upside down on a $500,000 house, I mean, they just picked up, they just got $125,000 free dollars.
Yeah. If you outlive a reverse mortgage, meaning there's no real end date, but if you outlive the value of your home, it's like you probably did the right thing because you got to be in there for that amount of time without having to make any payments. Pretty sweet deal.
Yeah.
We haven't seen that in 15 years. But there were some that went upside down, like in the early mid 2000s and things after the market crash, 2010.
Yeah.
You mentioned one other challenge with it though, the life expectancy. So the reason this reverse can't go on forever is because it's based on the individual and their age, just like life insurance. It's the exact same thing. So when they die, you can't just carry it over. It's like they've based all the numbers based on the life expectancy of the borrowers on the loan.
Yeah.
So they've got to have, I guess you call it an end date, so to speak, because there's no fixed term to it. There's no checks and balances that you're out of equity. There's no you've had the reverse mortgage too long. It's simply once you do a reverse, as long as you're living in the home, it goes on for infinity. But sometimes the kids want to keep the house and they just don't really have the means to do it. Maybe they can't qualify for a mortgage. Maybe they don't have the cash. And so that's one of the things to be careful of is if they're going to want to keep the home, they might not be able to. You never know.
Yeah.
But they won't be at a loss.
So because it's based on life expectancy, correct me if I'm wrong, but they only let you take out so much equity, right? Like you can't be, so 60, is it 60 or 62? 62 in Utah to qualify for a reverse mortgage. And you don't just get to say, well, I'm 62, so give me 95% of the value of my home in cash, send it to, wire it over to Wells Fargo for me. And, let's close up on this thing. It's a limited amount that you're going to be able to get out. And it's really giving it room to run in terms of there has to be space for that interest to accrue sort of over time.
Yeah.
And the way that I understand it to work is as you get older, right, the amount or that percentage, like if you could initially take out 30% of the value of your home in a reverse mortgage, maybe 5 years later, you can take out 40%.
Sure.
You get into your 80s, you might be able to take out
half of it,
50, 60% or something, right? Yeah. It's going to grow. Mm-hmm. What's where does it sort of start? Where does it sort of end? And what are the parameters that would adjust or could adjust those numbers over time?
Yeah. So it's based on 3 things: value of the home, the age of the youngest borrower. So if you're married, do it together. Whoever's younger, it's based on that person, because that way either one of them can live in it for the rest of their life. Mm-hmm. And then the one right now that's made them a little bit more tough to get done or make sense the last few years is the interest rate. So it's taken the value of the home, age, interest rate, and it's just a formula that says, okay, this person's going to live for this long. This loan's going to grow at this rate. We'll give them this amount of their home's value. Today, that's probably like about a third of the home's value for a 62-year-old. Really close to that.
Okay.
Pretty like rough numbers would be you get to use about 0.5% more per year of your home's value, or about 0.5% more per year. So you get somebody that's 82, they get another 10% of the home's value. So they're getting 45% now, roughly, something like that.
Okay.
Those numbers have all gotten lower for a couple of reasons, because the interest rate matters and they're higher than they used to be. And I do think you probably get this one from a life insurance. What is the life expectancy of a 62-year-old right now? People are all living longer. And so I think it's becoming a bit of a struggle.
Well, I think people forget that. They look at life expectancy today is going to be different than life expectancy of a person that's 62 today, right? So if you say like, well, the life expectancy of a male today is 78, right? Well, that's not the life expectancy that's a life expectancy for somebody that is like 78.
Yeah,
right?
That's not the
like,
life expectancy for our kids.
Yeah.
Most likely.
So, so I heard a statistic, like, I don't have the exact, I'll tell you who told it to me. It's like, did you ever see the commercials back in the day with the guy in the cardigan? And it was like, it's Abacus Life or something. They do, it's called, life settlements.
Okay.
I'm going to leave it at that and not expand more upon what that is. But anyway, so I heard this guy speak, and he had the statistic. This guy basically buys life insurance contracts from people.
Yeah.
He said the life expectancy of somebody that is under 40 years old today there's like something like a 90% chance, or 90% chance that they will live to be beyond 100. I was like, that's crazy.
Yeah, life expectancy isn't based on how old you are. It was based on when you were born.
Right.
Really.
So
it's like this chase. How do they keep up with it? How do you know?
So I'm not an actuary, and I don't talk to a lot of actuaries, but I can imagine that they're probably projecting the person at 62 right now. They're not saying like, oh, he's going to have the same 78, life expectancy of 78. It might be 82 or 84.
Yep.
It's going to be incremental,
Yep. But
it's going to be more. I would think.
Yeah.
I'm not an expert in life expectancy.
I've just noticed that even in the 15 years that I've been around the reverse mortgage, and a lot of this has been figuring it out along the way.
Yeah.
So I just barely told you a 62-year-old could borrow about a third of their home.
Yeah.
So, what's on a $500,000 house? What is that? Like 150 grand, something like that.
Yeah, like 180,000,
something like that.
188,000 or something.
That used to be 60%. When I first started getting familiar with the reverse mortgage, a $500,000 house, a 62-year-old could borrow $300,000.
Yeah.
They must have found out that was too much and that people are living longer, because it seems like over time that's just slowly diminished, even though part of it is rates are higher now than they used to be.
The actuarial tables are changing underneath.
Yeah. So if you do live in the same home at your 62, that's probably the other hard thing, is that like people are living so long, like at 62, do you know this is your final house? It doesn't necessarily have to be your final house, okay? But most of the time it doesn't make sense if you see yourself. But
realize
moving.
You could get stuck. That's the you know what I mean? That's the thing that really consider. Like you could be 62 and you do run the risk, and correct me if I'm wrong here.
No.
You run the risk, like you get to 72 and you're like, man, we want to downsize, or we want to move to be closer to the kids or whatever. And now maybe you're not upside down on the home, but you have so much loan to value that if you sold this home and tried to get a new reverse on the other side of the country, you couldn't do it because you would be at too high of a loan to value balance on the new home.
Yep, absolutely. The one I use is, okay, you guys are both wanting to live in this together. You're 62, you're both still healthy. What's 82 going to look like if one of you passes away?
Yeah.
Doesn't mean we shouldn't do the reverse. It just means what's the plan, because 20 years from now, I can show you what your loan balance is going to be. Mm-hmm. We can guess what home values are going to be, but we don't know. I'm not guessing at what your loan balance will be. I know what your loan balance will be.
Yeah.
Will there be enough equity for you to do what you need to do? Now, if the answer is I've got a couple kids that are very well off, they will make sure I'm got somewhere to live. But if that's not the answer, I don't know. What does happen if you get stuck in that house that you don't want to be in?
Yeah. I'm going to call out that if you have means and you're only 62 and that's your main plan is your kids are well off and will take care of you, it's poor planning.
For sure. That's not a plan, right?
Yeah, it's not much of a plan. I think having a plan around setting aside resources and being real with yourself, saying, okay, well, one of us might have to get some in-home care, that come, and we might have to hire out more services, like to come clean the home, maintain the yard, whatever, right? Those are all going to be costs. Let's plan for those costs and have the money set aside.
Yeah.
Instead of just annuitizing everything I have.
Yeah.
The
flip side too is I've had some that are dual income earners.
Yeah.
But if they die, if one dies, then they won't have both incomes. And so they really right now today, I've actually done a couple of these over time. Today, they are totally fine making the house payment.
Yeah.
Typically husbands like, when I pass away, she's not going to have enough money or vice versa to do what we're doing right now.
Yeah.
And so by doing the reverse mortgage, we can keep making the payment so that if we do want to sell this house 10 or 15 years down the road, then we can. Mm-hmm. Or if I die tomorrow, she for sure has a place that she can live if she chooses to.
Yeah.
Because we lost some of my income.
Yeah. I think that the more we talk about it, the more I'm in my head, I'm feeling like this idea of having the reverse mortgage lines up really well with the concept of utilizing what's called asset-based long-term care planning, right? Which is where you can leverage a insurance contract for long-term care that can be done in your home. Right. So you can say, well, I'm going to live in this house forever. Well, after one of you passes, who's going to take care of you? Mm-hmm. You can have the kids come, and not to be graphic about it, but help you shower and go to the bathroom and eat your food. And you know what I mean?
And most people don't want that.
Most people don't want that. There's a certain level of dignity people want and that kids want for their parents as well.
Sure.
Right. And when times get tough, family will look after family like the way that good family does. But you also, if you're the person that feels that way, probably doesn't want it to come to that either.
Right.
So, I think getting a reverse mortgage, but also before you get to the point of you getting the reverse mortgage, potentially funding up the right type of long-term care insurance plan. I think those two things can help you access a lot of leverage. That's pretty prudent, right? Like mortgages are pretty prudent leverage.
Yeah.
And then I think leveraging an asset-based long-term care is a great way to access leverage that then, it can keep you in the home all the way to the end, right? Instead of get to the end and now the kids are dealing with it while you're still alive, but now you still have to figure out how to get into a home, right? And go pay for a retirement home or whatever, or care facility.
And the truth is most of them don't want to leave the home.
Most people don't.
They just don't. It sucks to move. They don't want to go live. My grandma says, I don't want to live around a bunch of old people. Well, you are 80 something, but she just didn't like the idea of it.
Yeah. I will say I have some clients that live at Ovation here in Washington County.
Yeah, very nice place.
It was a phenomenal place. For the people that it's a good fit for, it is a wonderful fit.
Absolutely.
And I've been impressed with their facilities and their pricing structure and the way that, all that works out for those people.
Yeah.
But that's a good outcome, right? That's a simple, easy to implement outcome, especially for like a surviving spouse type situation, where they don't want to look after a home. They weren't emotionally attached to it or something like that. But usually those people aren't going to have a reverse mortgage first, right?
Right.
Because they're going to be like, well, we're not attached to this home the same way.
Correct.
The reverse mortgage is kind of, like you said, for the person that's emotionally attached to their home, they want to stay in it forever. Well, if you want to stay in it forever, you want to make sure you probably can afford and have a plan for the care to stay in it forever as well.
Yeah, great idea.
And I know you're not a big insurance guy. I know you are like, not a lover of insurance. And I'm not super far off on you from that. I normally don't, I think people should have the insurance they need and nothing more.
Sure,
right.
100%.
But I think that's one thing that keeps coming to mind as we talk about this conversation. When people are starting to think like, okay, a reverse mortgage could be for me, or my parents, right? I think if I look at the demographics of who listens to this podcast, it's more likely a listener is going to be saying, should my parents be getting a reverse mortgage?
Yeah.
What are some questions that people should be asking themselves, and then also asking a lender as they start that conversation? Like, what are the red flags to look out for that, maybe this isn't for me, or maybe somebody's trying to oversell me, or I should be aware of or concerned about?
Yeah. I think it's kind of like what we're talking about. It's like, what's the plan beyond the next 6 months? What's 5 years look like? What's 10 years look like? What happens when one of you die? Where are you going to go? What other assets and plan do you have in place? Sometimes the answer is we just need to downsize our home. I'd love to say that you should do a reverse mortgage and stay in the home, but maybe this home doesn't match where your financial situation is. And so instead of doing a reverse mortgage, staying in a home that you truly shouldn't be affording, maybe it's downsize. I think it's just like, what's this going to look like? What's this going to look like for you long term? You know, it might be really cool to be 62 years old and not have a house payment. And maybe that's the right thing to do, but maybe it's not. So it's like just trying to look ahead, I think.
Yeah.
What's it going to look like for the kids? What's the other financial stuff like? I mean, that's what your job is, right? You're trying to look forward however many years into the future and go, you know, things can change, but like we need to predict what we want or make a plan for what we want it to look like, and then we'll work towards that.
Yeah.
Crap can change, but at least we had, you know, we put the ship in the right direction to start.
Yeah. I think one of the questions I would encourage people to ask is like, what problem am I solving with this product?
Yeah.
Right.
Does it change your life to not have a house payment? Or does it change your life to put less money down when you buy a home? Because that's what most people know. You can buy a house with a reverse mortgage. It doesn't have to be a home you already own.
Yeah.
Like my grandparents, it did. It changed their life to be able to buy a better home, because that was like everything for my grandma.
Yeah.
And I'm like, that's the right reason to do it. It did change your life.
Mm-hmm.
Yeah.
Yeah. One of the things that if somebody was super risk adverse, could they consider a reverse mortgage? Like I'm going to have a reverse mortgage on this house and I'll eliminate that, you know, make that mortgage payment. I'm not going to eliminate it. I'm just going to make it optional. But I'm specifically doing a reverse mortgage. So that way, if the housing market goes to hell in a handbasket, right. And you know, my sources of income otherwise have dried up. Like I can't get kicked out. I can't get evicted. I can't, you know, as long as I can pay the property taxes and insurance, I'm going to keep the home.
Yeah.
Like, regardless of whatever happens with, you know, the market. And again, non-recourse. So I know I have a place the rest of my life.
Yeah. And you can also,
I don't love that kind of planning, by the way.
No, I know, but I think it does make sense in some situations. And the one thing that is really cool about the reverse is all the flexibilities it has.
Mm-hmm.
So let's say somebody comes to me, $500,000 house, they owe maybe 50 grand. This is actually fairly common. You kind of mentioned it. Well, number one, let's pay off the mortgage so you can retire.
Yeah.
Number two, it's 5, you only owe 50. There might be another 100 to 150,000 of available equity that we could either use in the form of a line of credit to supplement your life, or we could set you up on kind of like an annuity, but a monthly payment for the rest of your life. We don't have to start like that. We could say step 1, pay off the mortgage. Step 2 is you've got 150,000 in available line of credit for if life happens.
If you sort of like, you know, you said like annuitize, like set up that monthly payment that comes out, that's not guaranteed, correct? Like that's because if something happened to the housing market and the value of the home dropped and, you know, your balance is continuing to increase at a certain point, your loan to value is too high. There's no more equity to draw on to get the monthly paycheck out. Am I correct?
No.
All right.
So that monthly payment, you can set up a monthly payment for life, and they're taking the exact same risk from an equity and a life expectancy table. The FHA is taking the risk essentially.
So they are, I mean, that is annuitizing then.
Mm-hmm. So you could say $500 for the rest of your life, regardless of how long you live and regardless of what happens to the real estate market.
And the account is still just accruing interest on those draws. Yep. So if, you know, 5 years down the road, you decide to change your mind and you sell the home.
Yep. Right.
It's just, you just pay off the loan balance like normal.
Yep.
Okay. That's a cool planning tool.
And you can just adjust that too. Like I say, I think like some of the best ones are like we do a combination of a bunch of stuff. Mm-hmm. Okay. We've got rid of your house payment. We've got 30 grand on a car loan. You need to have a decent car. You got to go to the doctor. So let's pay the car off with the reverse. Mm-hmm. Now we got another 100 grand here. You could either choose to leave that for a rainy day, or let's see what the numbers say you could get back in a monthly payment. Maybe it's $300-400 for the rest of your life, but would that matter? Would that be a big enough number to, you use the example, which I think is the best one, is, will that allow you to retire and quit having to go to work every day? You don't want to work every day when you're 75. Could we pay off your loan, pay off your car, and give you $300 a month and keep you in the home and have you retire today? Those are the best ones.
Yeah.
Because you've changed their life.
Life changing with reverse mortgages. We might be the only two people in the world that think like this is an interesting topic. But,
probably.
But I think there's a growing number of people out there that their parents really, you know, are candidates, or they're either considering it and it's not for them, And the only thing their kid knows how to do is say, it's horrible and you should never do a reverse mortgage, mom and dad. And then mom and dad are saying, but our loan officer is telling us it's this great, super safe thing that, it is just amazing for us. And the kid, you know what I mean? And all of a sudden you don't really know how to coach your parents to a good decision.
Yeah.
I think so understanding it to say well, that's not necessarily true, or let's get some more information on that. Because it could or couldn't be, right. But having some awareness around hey, could mom and dad really benefit from this? Or is that something that would be really counterproductive to, right? And the one that I always see is if mom and dad are really well off, it just doesn't make sense for mom and dad to spend $15,000 on closing costs to just have it in place, just to have it.
Yeah, what's the benefit?
So just being aware of that and what's available to mom and dad potentially, right, can make a difference, and hopefully people get some value out of that way on this podcast.
Probably the most frustrating thing for you and I's profession is when we know the situation and we think this is probably the right option for these people. And we try not to sell them on it, right? You just say, I believe this is the right planning mechanism.
Well, I don't write reverse mortgages, so I can't sell them on it.
But not a reverse, but I mean, any sort of planning advice.
Yeah.
And they've got somebody outside of the scenes that is advising them, but they don't have context.
Yeah.
So I'm not saying you should jump in and get your parents a reverse mortgage. I'm saying don't immediately say, oh, it's terrible, it's the dumbest thing ever. And you're like, could we change mom and dad's life? We at least ought to learn about it.
Right.
And then if after you've learned about it and met with me and you go, it's just not the right thing because this, and this, it's that's great. We made a good decision together.
Yeah. Yeah. I think if you're going to have an opinion about it with your parents, you should just get involved fully in the conversation, right?
100%.
I think good kids do that and tend to do that.
Yeah.
And I think a lot of parents are actually more open with their adult kids that way about the finances than most people would assume or expect.
Yeah. Mine, like I said, mine that always go the best is there's one kid that's kind of in charge of everything and they think this is the right thing. And a lot of times they're kind of pushing the mom and dad to go this is the right thing to do.
Yeah. Yeah. I know I have multiple 3-generational families that I serve where mom and dad came in and now I'm helping their kids, but mom and dad along the way have also brought in their parents because their parents were getting, skewed advice or, maybe some concerning ideas or whatever. Right. And so now I'm helping 3 generations.
Cool.
And it's fun to see the positive impact it has on a family when there's good communication, literally across multiple generations.
Yeah.
And I can see it all working, how that wealth transfer is actually going to take place. And not just in here, hey, here's a check, but in, mom and dad have helped make sure that their parents, get across the line. Okay. And everything's buttoned up there. And then they're already instilling in their kids good financial principles. And here's how you deal with, hey, watch how I've dealt with, your grandparents and we're kind of doing these things and helping them. And right. And now I want to make sure that you are in a better situation. So start doing these things and coach them through it. And, a lot of them are my smallest clients. Right. But they're really young and their parents are great clients. And I love working with them because it's something simple where you're coaching them through some basic stuff, but you're helping lay down the foundation of the value of money and what you can do with it and how you can help and how it can be a positive impact to the family, especially when there's good communication around it. So
yeah, it's the best.
Oh, it's actually one of the most fun
100%
parts of what I do.
And parents bring their kids into me I help the parents buy a house and they're dragging their kids in to figuring out how to get a loan, and buy a house. It's awesome. I
think parents that help their kids get a house is a majorly positive, impactful thing. Yeah. Going back to the whole estate planning idea, we're always thinking about, mom and dad leaving the house behind for the kids. But we just said what's that going to do if you die at 90 and your kids are 70? They already have their own reverse mortgage. You know what I mean? It's or whatever. It's but if instead of worrying about giving them a house at 70, you help them buy their own house in their 20s.
Yeah.
That would have really likely changed the trajectory of their life. And it would have maybe put mom and dad in a spot where they need to have a reverse at 90. And maybe there's not a lot of home equity to give at that point, but the kids are probably so much better off.
Yeah, for sure.
That, I don't know, everyone go about it their own way, but I think there's really valid planning to do there, especially for people in their I would say like 40s, 50s, and maybe early 60s, where you really start to look and say, what can I do that's impactful right now on the next generation, and start that legacy planning that way.
Yeah, 100%. A lot funner that way too.
Way more fun.
I've had people do it, and they wanted to funnel grandkids' college money. Mm-hmm. They're like, my grandkids are 17. I don't think their parents quite have the money. I think it's really valuable they go to college. I want to help them get through college, and so I'm going to move some things around in my finances to help them today.
Yeah,
I might leave them less down the road when I die, but I want to be able to watch them do this the right way. And I get to, while I'm alive, I get to dictate how this money works.
Yeah.
Make sure they're spending it the right way and being good kids.
Yeah. If you estate plan while you're alive, you have way more control over it.
Yeah.
So anyways, well, appreciate you taking the time, Chantry. Hopefully people get something out of this. And I think you're my first repeat guest on the podcast.
Ooh, I love it. I like being the repeat guest. Thanks, brother.
Chantry, people can find you on Instagram. Facebook. Where do you
Google Chantry Abbott or Guild Mortgage.
You'll pop up
Instagram,
on
Google, something. You'll find it. There's not very many Chantry Abbott, so it's not too difficult.
Yeah, it's a unique name for sure. But Chantry Abbott, you're at Guild Mortgage, licensed here in Utah. Any other state licenses you carry?
Yeah, pretty much everything touching here. So even California, actually. So Utah, Nevada, Arizona, California, Idaho. I don't know if I said Arizona. All those, 5 or 6. All touching. Yeah. In fact, this might be a different conversation, but I'm licensed in Alabama and Oklahoma because I've been funneling some investment clients there. That's probably a whole nother conversation, but
we can have you back on to have that conversation.
I'd love to.
Interesting. Okay. Well, if someone has questions, feel free to reach out. You can reach out to us at Ducharme Wealth Management. You can hop on our website at ducharmewealth.com, hit the contact us form, send in your question. We can get you connected with someone like Chantry or Chantry himself if you're in a state that he's licensed. And hopefully we can help, you put the plans together before you get a product and help you understand that the product is a good fit or not.
Yeah.
So
beautiful. Thanks for having me, bro.
Okay.
Fun.
Talk soon.
It's always fun.